The hedge fund run by Sears CEO Edward Lampert has offered to buy the retailer's popular appliance brand Kenmore and other Sears divisions, moving to break up the company after it failed to find other buyers for the assets. Sears said it has received a letter from ESL Investments suggesting that it acquire a lower portion of its Kenmore brand, the home improvement business of the Sears Home Services division and the parts direct business of Sears Home Services. Hoffman Estates-based Sears Holdings Corp. has been exploring alternatives for those businesses, as well as the Craftsman and Die Hard brands, for nearly 2 years. In 2016, Sears did not say what kinds of options it was considering, but ESL Investments told Sears it should aggressively pursue divestiture of all or some of those businesses after failing to find a buyer for assets other than Craftsman. It sold the well-known tool brand to Stanley Black. Sears shares shot up 7.6% Monday to close at $3.24. A sale would give the retailer a cash injection as it works to restructure its business after racking up more than $10.8 billion in losses over the past 7 years. The company has said it believes there's room to grow those brands by expanding their distribution beyond Sears. The brands would continue to operate as they have, according to the letter to the board of directors, which was filed with the Securities and Exchange Commission. ESL also offered to buy certain Sears real estate assets, including debt, and continue to lease the properties to Sears or other entities. Alyssa Pointer, Chicago Tribune. The home appliances department at the Sears located inside of Whitfield Mall, Tuesday, May 9, 2017, in Schaumburg. A hedge fund owned by Sears CEO Edward Lampert has proposed buying the brand and other assets from the struggling retailer. The home appliances department at the Sears located inside of Whitfield Mall, Tuesday, May 9, 2017, in Schaumburg. A hedge fund owned by Sears CEO Edward Lampert has proposed buying the brand and other assets from the struggling retailer. Alyssa Pointer, Chicago Tribune. As noted in our letter to the board of directors, our proposal is part of a comprehensive solution to transform Sears Holdings, ESL said in a news release. Our principal interest is seeing that Kenmore, Ship, Sears Home Improvement business, and Parts Direct are divested in the near term in a transaction that delivers the greatest value for Sears, regardless of whether ESL or a third party is the ultimate buyer. ESL said, "This will enable Sears to improve its debt profile and liquidity position, creating the runway to help continue its transformation, and allow these businesses to unlock their considerable potential by further expanding their presence in the marketplace. We are very enthusiastic about our ownership interest in Sears and its future, and will remain so whether or not a transaction is consummated." ESL valued the Parts Direct and Home Services division at $500 million. It did not provide a valuation of the Kenmore brand but offered to submit a proposal and said it believed it could close on a deal in 90 days. Sears said it will review the letter but would not make an additional comment. To ensure fair and reasonable terms, given the close ties between ESL and Sears, ESL said Lampert and Kunal Kamlani, president of ESL and a member of Sears board, would not participate in discussions, deliberations, negotiations or decisions on behalf of Sears unless specifically asked to do so. ESL also said it would not purchase the businesses unless the deal was recommended by a Sears board committee and approved by a majority of disinterested shareholders. Using the pieces of its retail empire to generate cash isn't a new strategy for Sears, which closed 426 stores last year and has repeatedly tapped Lampert for loans as it works to stem the red ink and slash costs. Spun off the Lands' End brand in 2015, bringing in a $500 million cash dividend. A year later, Sears sold 235 stores to real estate investment trust Seritage Growth Properties, in which Lampert holds a stake and serves as chairman of the board, and raised $2.72 billion. Transactions announced since the start of 2017 added up to more than $1.8 billion in additional capital, according to a March report from Moody's Investors Service. The sum includes asset sales and loans backed by Sears real estate and intellectual property, excluding the Kenmore and Die Hard brands. But without the Kenmore, Home Services and Parts Direct businesses, Sears looks like a bunch of empty stores, said Eric Gordon, assistant professor at the University of Michigan's Ross School of Business. A brand like Kenmore might be better off with an outside buyer with experience building brands, but its ties to Sears could make that a harder sell, he said. Gordon said it's hard to see a way the businesses would benefit from separation, beyond the cash infusion for Sears and ability to sell assets before they lose value. There's no apparent strategic logic here. But there is some financial protection logic, he said, if Sears were to have to seek bankruptcy protection. And while the company still has a meaningful amount of real estate and other brands that could provide a source of cash, the more it sells, the fewer assets it will have to fund future shortfalls, Moody's said. Moody's also noted Sears issued $1.8 billion of securities backed by royalties from the Kenmore, Craftsman and Die Hard brands, which could affect their value. Chris Shropshire at ChicagoTribune.com, Will Zembach at ChicagoTribune.com, Twitter at Corliss, Twitter at Lauren Zumbuck. Related stories: Sears to close last store in Chicago, the city that helped launch its growth into a major retail presence. Sears slashed more than 50,000 jobs in 2017. Sears' latest $100 million loan again comes from CEO's firm. Sears, once an appliance powerhouse, sees sales shrink despite growing demand.